Hello, can you hear me? Yes. Okay, we'll start the conceptual framework projects. That means the conceptual framework for financial reporting. I think you are familiar with this framework. We discussed this framework in maybe in financial accounting and maybe in advanced uh, financial accounting, etc. Here also we are discussing, but little bit, advanced way. We are discussing the same thing. Overview of conceptual framework financial reporting. We have been discussing the conceptual framework of financial reporting as an accounting theory. We will be discussing and importance and limitation of conceptual framework will be discussed. So just to come, when you look at the framework, the objective of financial reporting, we need to discuss objective of the reporting or preparation and presentation of financial statement. It is to provide financial information that is useful to user in making decision related to providing you resources to the entity. I think it's very clear. You are familiar with this objective. Financial reporting is to provide financial information that is useful, that is relevant, that is, faithful to users in making decision relating to providing resources to the entity. When you say useful to users, it has two aspects. One is the relevance, and other one is the faithful representation. So we are providing fundamentally faithful and relevance information for users to provide or to make decision about the resources to the entity, providing resources to the entity. So here the providing resources means when you talk about providing of resources in the sense of capital. So we give equity capital and you give, debts as, capital. So thereby basically resources to the entity means you are providing, capital to the entity to make that. Or maybe even if you look at a little bit further, resources maybe you are appointing by looking at the annual reports, and you may appoint new board of directors, new directors. Again, those are really, resources. Anyway, basically here the resources means capital that can be divided into two parts, maybe equity capital, maybe debt capital. Now, what are the decisions you are providing, taking? So you may take a decision to buy shares. You may take a decision to, sell shares or withdraw equity, or you may take decision to, give some debt or to sell your debt. Likewise, debt instruments, maybe you keep or you buy or you sell, you hold. Then other one is providing or settling, loans and other forms of credit. We don't have, a highly developed debt market in Sri Lanka. So thereby our debt is in terms of giving loans, giving advances. So thereby providing or settling loans and other forms of credit also coming under this. So that is another kind of whether to give loan or credit, maybe short term, maybe long term. Voting and otherwise influencing management's actions. So you may use the financial reporting to make voting decisions, whether to appoint a new auditor or whether to appoint a new director or board of directors, something like that. So thereby basically financial reporting is to make decisions. So you provide information, useful information to make decisions. Here the useful in the sense of relevance and faithful representations. There, of course, you take either to hold or either to buy equity instruments or debt instruments, or to settle loans and to grant a loan or to take a credit decisions and also to make a voting decisions. So those are the example for users decisions. Again, then when you take users to take a decision, they need to, they can't just, take a decision by just looking at the appearance of the financial statement or the surface of the financial statement. Just looking at the figures, you can't take a decision. So thereby, users required to, evaluate or assess the financial reporting or the financial statements, data or the information contained in the financial statements need to be, evaluated or assessed. One area would be prospect for future net cash flows into the entity. So you may look at whether the particular business is in a situation has the capacity to generate future net cash flows. If that is, what would be the timing and amount of those net cash flows. So thereby, a cash flow prediction is fundamental when you are making a decision by using financial reporting. So thereby, your financial statements, when you prepare and present financial statement, set of financial reporting or the statements should have the capacity of predicting net cash flows. Of course, by looking at your balance sheet, you may predict future cash flows with the combination of a cash flow statement. Then the management stewardships of the entity's economic resources. So economic resources are there. Stewardship means whether the management, the board of directors are looking after, taking care of the resources in the business. What are the resources? Resources means all the assets. All the assets appeared in the balance sheet is coming under the resources. So thereby, management stewardship means whether these people are really, take care of those resources. Maybe the strong internal control, internal accounting and internal control systems, a good return for economic resources, assets, a reasonable return, ROI, return on equity, or maybe asset turnover, maybe total asset turnover, maybe current assets, maybe the non-current assets turnover. So you can evaluate the efficiency and effectiveness of resources employed by an organization. So by evaluating such things, you are just like to make an assessment, opinion about the management stewardship, whether they are looking after, whether they are take care of, whether they are really managing the assets in a productive way, in an efficient way, in an effective way, will be assessed. So thereby, decision makers should really assess or evaluate financial reporting from two perspectives. One is the ability to generate, a net cash flow of the entity, and also about the management stewardships. That means by using financial statement analysis, you may look at the return, liquidity, long-term solvency, etc. Different kind of ratios, different kind of analysis may helpful you to assess the financial information in financial statement for you to make the decisions. That is the second part. The second part is to make assessment. You see, user needs information. User need information. Just you can't just assess very. You need information. So the entity economic resources claims against the entity and changes in those resources and claims are important. So what are the entity's resources? Assets. When you say assets, you may classify, may categorize, you may group them into different different ways based on the accounting standard. Basically, if it is a non-banking institutions or the business organization, we normally classify assets into non what do you call current and non-current assets. Even non-current assets, you may have different kind of assets. You may be intangibles, tangible assets like property, plant, equipment, investment properties. Then you may have the investments, investment in quartered or the what do you call the market-oriented investments, maybe fair value through profit and loss, maybe fair value through other comprehensive income, amortized cost investments. So you may have different kind of economic resources, and the claim against entity. That means to get these resources, to get these assets, you need financing aspects. So thereby, how those how those resources are being financed will display in the balance sheet. And also, it is important to understand a change in those resources and claims. Of course, statement of changes in equity, cash flow statement will really tell us the changes in those resources and claims. So those are very important for us to, when assessing those two areas, prospectus of the prospect of the future cash flows, and also the management and stewardships. So thereby, that's why we just provide you, in addition to financial positions, you are giving you the statement of changes in financial position, and we are giving the profit and loss, other comprehensive income, and also cash flow statement. So by looking at all these set of financial statement, you will be in a position to evaluate or assess those two areas. Then how efficient and effective management has discharged its responsibilities, use the entity's economic resources. When of course, when you have economic resources, against those economic resources, there are obligations. So when there are obligations, of course, how effective, how efficient you are discharged. Now, take this country. Now we have taken many loans, but our debt servicing and discharging those responsibilities are very, very bad, and thereby country, the world has declared Sri Lanka as a bankrupt country. So I think even when you look at the financial statements, we may understand discharge of its responsible use entity economic risk. That's why when you look at the financial statements, obligations may divide into current and non-current. Now you say, if you take a lease, if there's a lease liability, we divide that the liability into what is the non-current portions and the current portions. Next year, how much to be settled, and after next year, after that particular next year, then up to 5 years, what is the portion? So I think even additional notes, additional information about obligations may help for us to understand the responsibilities of discharging claims against those resources. So thereby, what I'm trying to tell you is that to achieve this objective, a user needs to evaluate two areas: prospectus of net cash flows and the stewardship of the management. And for that, you need the information about resources, claims, and changes those claims and resources, plus how successful you are in discharging the claims that you have taken to get those resources. I think that's very clear. Then a qualitative characteristic of useful financial information. Then Question is, what do you mean by useful information? What do you mean by useful financial information? Now, when you look at the useful information, there are two principles. One is the relevance, other one is the faithful representation. Those are called, as per the conceptual framework, fundamental qualitative characteristics. There are two fundamental qualitative characteristics, that is relevance and the faithful representation. I think you are familiar with these two. In addition to that, there are nice to have qualitative characteristics. We call it enhancing qualitative characteristics. So thereby basically useful financial information has two characteristics. One is the fundamental, other one is the enhancing qualitative characteristics. Anyway, what is relevance? Relevance is basically, you are familiar with this. Information is relevant if it is capable of making a difference to the decision made by users. So if that information is not provided, so you may take something else. If you provide that information, your decision is different. So thereby, what is not provided or what is provided now, relevance for the decisions. Financial information is capable of making a difference in decision if it has predictive value of confirmatory value. So you should have the predictive value. Predictive value means so you will see that next year this much would be the situation. So that is predictions. We call it confirmatory value. So thereby confirmatory value or the predictive value would be, center, or the centrality of the relevance is the predictive value. Predictive value means your ability to prospect the future cash flows. That's the predictive value. So you know that financial statements really basically based on historical data. You prepare the financial statement or the balance sheet as at today based on the last year data or last year transaction. But your balance sheet is, even though you use historical data, what already happened, the transaction incurred to prepare the balance sheet and other financial statements, but those financial statement has the capacity or it has the characteristics of predicting future. So thereby financial statement or the financial accounting, or it's not past, it's future oriented. It's future oriented. The second one is relevant representation. When you say faithful representation, no, I'm sorry, faithful representation, information must faithfully represent the substance of what it purport to represent. That means information always should reflect the reality, not the legal matter. Legal matter is not important for us to when we talk about the faithful representation. What is important is reality. Reality in the sense, so whether that particular assets is really used by your business to generate cash flow, or that obligation or that liability is yours, even though you don't have a legal obligation to settle. So thereby substance over form, or substance is another principle. Substance over form, or substance is the another principle in financial accounting. Substance is important. Reality is important. That's why when you look at the definition of certain concepts in financial accounting, for example, assets. When you define the assets, we don't worry about the ownership. We worry about the controlling power. Who is having the controlling power? Controlling power is, potential resources, but controlling power is important. We don't ask who has the legal right, who has the ownership of this particular asset. No, we don't have such question. That is because of substance. Even if you look at the obligation definition, liability definition, we look at the present obligations, irrespective of legal obligations. So your obligation may be constructive obligations or the legal obligation, maybe by agreement or maybe without any agreement. Just expectation norms and values may develop a kind of a liability. So thereby I think faithful representation is important. If you look at all the accounting standards, especially the recent accounting standards, revenue recognitions. Just look at the revenue recognitions. Revenue recognition standard is really, revenue recognition is focusing much more on substance. We don't worry about who raised the invoice, at which point you raise the invoice. Invoice raising point is not relevant for us to revenue the revenue recognition. So whether there are certain conditions for different transactions. If those conditions are satisfied, we consider that has been realized. So thereby, substance is a key faithful representation. The second one is faithful representation is to maximum extent possible, complete, neutral, and free from error. So it has to be maximum extent possible. Maximum extent possible. What do you mean by maximum extent? The maximum extent possible. We have to look at three things. One is complete. It has to be a complete transaction, right? And neutral, not bias, and free from error. When you are making judgments, you can't make errors. Free from error, right? So faithful representation has three aspects. Another three aspects, it has to be complete, it has to be neutral, and free from error. So we call it maximum extent possible. Then faithful representation is affected by level of measurements uncertainty. Higher the level of uncertainty, higher the problem of faithful representation. That's why when you look at measurement uncertain cases, we develop certain strategies to address the faithful representation. For example, you know that when you are revalue your assets, maybe property, plant, equipment, maybe land, maybe a machinery, a kind of machine, you may revaluate as per as per the property, plant, equipment. Revaluation may be done. When revaluation is taken place, judgment involved, professional judgment involved, not the historical cost. So thereby, when judgment involved, uncertainty is coming in. Maybe market price, maybe you are assessing, maybe you are valuing. Valuation is being done for the revaluation purposes. But when uncertainty is there, what we do is to address that, we use certain strategies. One strategy would be disclose. When measurements are uncertain, you use the disclosure strategy. Additional notes. Who did the revaluation? When? What was the method? Were there any barriers, limitations? So you disclose all those things. Measurement uncertain. So what I want to communicate to you is that when the high level of uncertainty is there, you need to disclose more information. But we know that if the uncertainty is very high, we won't get those things into the financial statement. But anyway, a certain level of uncertainty is there when you try to measure, when you try to assign values to the transaction, especially if you are using alternative method for historical cost. If your method is not historical cost to value the assets, to value the liabilities, of course, measurement uncertainty is coming in. Then qualitative characteristic of use plan continued enhancing qualitative characteristics. comparability, verifiability, timeliness, understandability, all these are, nice to have. We call it enhancing qualitative character. That means faithful representation and relevance would be enhanced if you comply, if you try to, ensure those characteristics like comparability, verifiability. Verifiability means someone can really examine, an independent person come and examine what is presented in the financial statement are there. So there is a documented process. There is a high level of internal control. There is a high level of accounting controls. Then the verifiability is there. Verifiability is there. Most of the economic, crises, the corruptions and the frauds in Sri Lanka economy taken place, verifiability is not there. Verifiability is not there. That's why they are, giving many talks. Just go to the court and see. Verifiability is important. Verifiability is ability to inspect, ability to check, ability to test. When you test those things, you can compare what is being reported. So there is no difference between what is being reported and what is there in the documentation. So internal controls, accounting controls, and keeping documentations, systematic way of having documentations is a kind of example for verifiability. When you do go for some audits, so you do the verifiability as auditors, you examine, you do the verification. You may verify, you may check the balances, what is appeared in the balance sheet. So you may adopt different alternative audit procedures to verify the particular item or particular balance. Verifiability. If verifiability is weak, it's very difficult for you to make an opinion. Timeliness. So information has to be, presented within a reasonable time. Maybe as per the conceptual framework, it is within 6 months of the balance sheet date. Timeliness, understandability. So you should be in a position to understand. These 4 qualities of characteristic enhance the useful information, but they cannot make non-useful information useful. So if the informations are non-useful, you can't make them useful. So thereby, that's why we label it as, when you say useful, why we are making useful informations. So we use the, fundamental characteristic as useful information. Firstly, those 2 characteristics should be there. By incorporating these enhancing characteristics, you may enhance the usefulness of financial. So thereby, if your informations are not relevant, if your informations are not faithful representation, I don't think that you will have the enhancing qualitative characteristics. You will have the enhancing qualitative characteristics. Okay. Then, when you provide information, always there is a cost constraint. Constraint means value and the benefits. Always you compare value and the benefit. Benefits of providing information need to justify the cost of providing and using information. If your benefits are more, cost is less. Benefits are more, cost is less, then of course you can provide the information. If on the other hand, you have to incur more cost but less benefit, I don't think you will go for that. That's the cost constraints. Okay. That's why we talk about, when we talk about the small business enterprises, I don't think they will introduce strong quality internal control system, accounting control system, because to introduce accounting control system, for them to, they have to incur many much more cost. For example, segregation of duties. In a large organizations, even though you see the segregation of duties, even in a system, you may say someone is initiating the transaction, someone is verifying it, someone is recommending, another one is approving. In a system, you may get those controls, but if there is 1 or 2, 3 people, small business organizations, I don't think such segregations, that such control system, such internal control system, you can observe because of the cost benefits. Then another concept is reporting entity. We need to understand the reporting entity. So far we discussed, objectives of financial reporting. Then we discuss what do you call usefulness of financial reporting or the information. Then we are going to discuss reporting entity. An entity that is required or chooses to prepare financial statements. That's called reporting entity. Now, suppose by law, according to the Companies Act, listed companies should prepare financial statement. According to the Accounting and Auditing Standards Act, list of specified business enterprises need to prepare financial statements. So those are an entity that is required. That's called those businesses. And also you may choose as you are a partnership, you may choose, you may think, you won't prepare financial statement. If that is the case, we can consider even partnership, even a sole proprietorship as reporting entity. Are you clear? Reporting entity arises based on two things. One is required by law, another one is chooses. You choose. That's your option. So if you decided, even though there is no legal requirement, you decided to prepare financial statement, then your organization can be considered as reporting entity. Right? So certain organizations required by law to prepare financial statements, then those organizations also we consider as a reporting entity for the accounting purposes. Not necessarily a legal entity, could be a portion of an entity or comprise more than one entity. So it may be a group of business or consolidate financial statement. When you prepare the consolidate financial statement, we consider group as the reporting entity. You may prepare the financial statement for a branch. You select your management wants to prepare that. Then the branch can be considered as the reporting, even though there is no legal record. I think you got my point. Then, of course, the next one, determining the appropriate boundary of reporting entity can be difficult. For example, entity is not a legal entity. In such cases, boundary is determined by considering the information needs of the users of the entity financial statement. Those users need information that is relevant and faithful representation of what is purport to represent. A reporting entity does not comprise an arbitrary or incomplete collection of assets, liabilities, equity, and income and expenses. The reporting entity does not comprise an arbitrary or incomplete collection of assets. So thereby, at least you should have the double entry system. So then you consider, but think that when you select, even though there is no legal requirement, when you select prepare financial statements, boundaries determine considering the information needs of the users of the financial. So in such cases, boundaries, of course, difficult to decide. Okay. If it is a legal entity, yes, boundaries are there, accounting standards, you can't deviate from the accounting standards. But if it is not a compulsory situation, of course, boundaries are very difficult to. It depends on the requirement of the management. I think it's clear. Okay, financial statements. Financial statement, of course, you have the consolidated financial statement, unconsolidated, and combined financial statements. Then the elements of financial statement, I don't think that I should take more time to define what the assets, what the liability, what the unit of accounts. I think you are familiar with these assets. But when you define the assets, substance, whatever the concept, you have to understand very clearly whatever the concept, when we define in financial reporting, you have to remember the first priority, centrality of the definition is substance over, not the legal aspect. If you look at the definition of assets, if you look at the definition of liability, you will see that all cases, centrality of the centrality of the definitions, of course, assets and liabilities are the substance. So you see, present economic resources controlled by the entity. A present economic resources, not the past economy. Today you should have certain value. If you don't have present economic, we are not focusing on future economic resources also. We are not focusing on past. Present economic resources will reflect in your balance sheet. Otherwise, no. That's the point. If there is no present if it is not having a present economic resources means your ability to generate future benefits, economic benefits. So your resources should have the economic benefits. Otherwise, you can't consider as a present economic resources. Controlled by the entity as the results of a past event, an economic resource is right, that is the potential to produce economic benefits. Okay. A liability also a present obligation of the entity, not the past, not the future. Present obligations of the entity transfer an economic resource results of past event. An obligation is a duty or responsibility that the entity has no practical ability to avoid. So there is no alternative. When there is the obligations, you have to do it. You have to fulfill the obligation. So liability, assets, unit of accounts, the right or obligations or group of rights and obligations to which recognition criteria and measurements concepts are applied. The unit of accounts means it may be the rights or the obligation of group of rights and obligation, group of obligations, rights. So if there is a right to receive economic benefits, if there is a obligation to settle, if there is a group of rights, what do you call this, cash generating units, group of rights, and group of obligations. So then, of course, you may talk about unit of which recognition criteria and measurement concepts are applied. So unit of accounts means the maybe rights, maybe the obligations. You can apply the recognition criteria and also the measurement criteria. Unit of account is selected to provide relevant information about the assets or liability or any related income or expenses. Now, when you look at the intangible assets, you can consider it as a unit of account because intangible asset recognition and measurement will have a separate criteria. Right? You may consider the property, plant, equipment as a separate unit of account. You may consider the investment property. You may consider the financial instrument, maybe fair value through profit and loss investment as a separate unit of account. So the idea is it has the recognition criteria, measurement concept. You can apply the recognition criteria and the measurement concepts. Unit of account is selected to provide faithful representation and substance of the transaction or other events from which, sorry, battery is low. Yes, we have to make it, yes, of course, yes. A unit of account is selected to provide a faithful representation of the substance of the transaction or other event from which the assets, liability, and related income and expenses have arisen. So faithful representation is linked with the unit of accounts. Then equity is the residual, of course, assets minus liabilities. Income is, increase in assets and decrease in liabilities, other than the, contribution from holders of equity. expenses is decrease in assets or the increase in liabilities, other than distribution to holders of equity, like dividends. So I think those are very clear. You can understand those elements of financial statements. All these financial statement elements are defined based on the substance or firm concept. Then we will be discussing the recognition criteria, the process of capturing for inclusion in the statement of financial position or statement of financial performance, an item that meets the definition of an assets, liability, equity, income, or expenses. It's the process of capturing inclusion in the statement of financial state. Financial statement, financial position may be the balance sheet, in our normal words, or the statement of financial performance may be profit and loss and the other comprehensive income. To recognize in these two statements that the process that you adopt, the capturing process you adopt, maybe transaction incurred, you look at the standards, you apply the recognition, you look at whether the definition is assets and liability, equity, income, expenses definitions are within, or then you look at the maybe relevant, maybe what do you call this, recognition criteria, then measurements. So all these process is called recognition. Recognition is appropriate if it results in both relevant information about assets, liability, income, expenses, and faithful representation of those items, because the aim is to provide information that is useful to investor, lenders, and other parties. So thereby, what is the fundamental principle for you to recognize any assets or liability? The fundamental criteria. The fundamental criteria for recognition, you know the meaning of recognition, but fundamental criteria. When you say recognition, it includes definition. Okay, you have to look at the definition of assets, liability, equity, income, and expenses. That is there. But to recognize, what is important is you have to comply. You have to see whether, you have to ensure that fundamental qualitative characteristics are really comply or adhere. That is relevance and the faithful representation. Recognition criteria, whether recognition of an item results in relevant information be affected by, for example, that means the factors affecting for the recognition criteria. Factors affecting recognition criteria. There are two recognition criteria, relevance and faithful representation. When you take the relevant, information may be affected by two things: low probability of flow of economic benefits. Low probability of economic benefits, then you won't recognize. Existence of uncertainty, high degree of uncertainty. Right? Maybe, I think, due to COVID situation, this matter you may experience. Due to lockdowns, your machines, benefits of those machines was very low probable. Even now, the situation in the country with these foreign currency issues, certain raw materials you can't import. Therefore, your machines in the business organizations, maybe whatever the existing machines, maybe low probability of flow of economic benefits, existence uncertainty. So thereby you may understand, if these two criteria, two matters are there, already recognized assets, the opposite has to be there, either impairment or derecognize. If you have already recognized a particular assets, that asset is there, that machine is there, because of the raw material constraint, non-availability of raw material, non-availability of inputs, you see that the benefits of this series of machines, group of machines, is very low. That's called low probability of flow of economic benefits. So thereby, there is a potential for you to do the impairment for these assets if it is already recognized. So thereby, what I'm trying to tell you is that recognition criteria may be really influenced, may be affected by recognition criteria means the relevance may be affected by two reasons. If there is a low probable economic benefits due to environmental changes, due to uncontrollable environmental influences, changes, and also if existence uncertainty. Uncertainty means future is uncertain due to environmental factors. So thereby your recognition is affected. You are, if it's a new asset, very difficult for you to, equity or liability, very difficult for you to recognize. I think you got my point. The second one is faithful representation. When you say faithful representation, whether the recognition of an item results in a faithful representation may be affected by many factors. Example, if there is a measurement uncertainty, very difficult to measure, very difficult to get the market value. Now, for example, fair value through profit and loss, financial instruments, equity instruments, nowadays, very difficult to get the fair value in the Colombo Stock Exchange. Measurements uncertainty is there because market forces, market mechanism is not working as usual. It's not normal, abnormal. Even you can remember during COVID situation, banking institutions, the guidelines, additional guidelines were developed by the Institute of Chartered Accountant to recognize, to present those financial instruments in banking institutions. Recognition inconsistency. If you are inconsistent, if you are having inconsistent way of measuring, faithful representation is affected. But that's why always consistency is encouraging. I think you can remember, change in accounting policy is not allowed. Change in accounting policy is allowed under the two conditions. If a revision or new accounting standard required, or to make more useful information. But even to make useful, relevant information, if you are changing the accounting policy frequently, recognition criteria, then it's very difficult to ensure the faithful representation. So it's not reliable, it's not natural, it's not complete. That's the idea. Then the presentation and disclosure. The way you present, the way you disclose, have a matter of faithful representation. Cost constraint recognition decisions, just as it's constrained another financial reporting decision. Even for this recognition criteria, cost constraint is a matter. Right. The recognition, the opposite is derecognition. Derecognition means removing of all part of recognized assets and liabilities from an equity statements of financial position. So you are removing from the balance sheet. So if the balance sheet is like a notice board, if a balance sheet is similar to the notice board, okay, if it is a notice board, when in a notice board, when the notices are getting outdated, old, the maintenance or the admin department remove the notices. Likewise, in your balance sheet, if your balance sheet is similar to a notice board, the outdated assets and liabilities, meaning that those are not having the characteristic of assets, those are not having the definition of assets, those are not having the characteristic of liability or the definition of liability, we will remove. That's why removal of all or part of the recognized assets or liability from an entity statements of financial position is called derecognition. Opposite of recognition, derecognition. Derecognition normally occurs for an assets when the entity loses control of all or part of the recognized assets. You lost your control. You had a machine, right? So you control it and you you released out this machine under the finance lease. Then what happened? It's no longer your assets, right? Because you are giving the controlling power to someone else. For a liability, when the entity no longer has a present obligation for all or part of the recognized liability, if there is no present obligation or part of, then you can derecognize. For example, you may have a liability to the income tax department, maybe tax payable, maybe 1 million. Due to a new rule, government will declare that all liabilities, all receivables from the taxpayers, year of assessment and this and blah, 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 we cancel. No need to make the payments. Then, of course, we need to remove that liability from our balance sheet, something like that. Derecognition aims of faithful represent both. Only assets and liabilities retained after the transaction that led to the derecognition. Derecognition aims to faithful representation, represent both any assets and liabilities retained after the transaction that led to the derecognition, the changes in the entity assets and liability as a result of that transaction. So this is, of course, derecognition is faithful represent any assets and liabilities retained after the transaction that led to the derecognition, and also changes in equity assets and results of that transaction. Results and the impact, that means, so by derecognizing, what we are trying to do is, we are trying to improve the faithful representation by removing the relevant component from the balance sheet, and also we are removing the income earning prospect of future profit or the benefits from the income statement. So that's why it says both measurements. We have measurements, different measurements, of course. We have historical cost measurement basis. Historical costs provide information derived at least in part from the price of the transaction or other event that gave rise to change in time being measured. Historical cost, you are familiar. Historical cost of assets is reduced if they become impaired, or historical cost of liabilities in increase if they become onerous. One way to apply the historical cost measurement basis financial assets, finance liabilities is the measurements that at amortized cost. So amortized cost, of course, coming under the historical cost, but basically historical cost of assets, normally, if there is an impairment, impairment of assets will brought in very easy. But when we are valuing assets at fair value, impairment is not required, because fair value is already subject to market changes. Historical cost measurement basis. But when you look at the most of the accounting standards, asset related or the liability related, if you look at the standards, they are deviating from, they are giving, particular standards are offering us alternative way of measuring instead of historical cost. I think if you look at the inventory is cost or NRV, whichever is lower. NRV is not the historical. Okay. Property, plant, equipment, cost, revaluation model. Intangibles. Likewise, always most of the standards really encourage us to deviate or use some other alternative measurements. What are the alternative measurements? Current value measurement base. Current value provides information updated to reflect condition at the measurement date. That's important. Current value measurement basis. We have basically, you will see two measurement: historical cost based measurement, historical cost base, historical cost measurement basis, Classic example is amortized cost. You may learn that amortized cost method under financial instrument. Second base is that current value measurement. Current value measurement. So current value measurement is always try to brought in new information into the measurement mechanism. New information, new condition about the assets, new conditions about the equity, liability. So new conditions about the assets and the liabilities are really brought in under the current value measurement. So thereby you see that, it's more towards relevance. So example of current value measurement bases are fair value. The price that would be received to sell an asset, paid to transfer a liability in an ordinary transaction between market participant at the measurement date. The price that would be received and to sell an asset or paid. That means you have not yet received it. That would be received. Actually, the price not yet being received and not yet being paid. That is the fair value. But you take the fair value from the market participant perspective and the measurement date. Measurement date. When you prepare the balance sheet as at 31st March would be the measurement date. 31st March would be the measurement date. Reflect market participants' current expectation about the amount, timing, and uncertainty about the future cash flows. Reflect market participants' expectation, those who are in the market. Now, for example, if there is a piece of land, there may be different market participants. A person who is interested in starting a car park, you can consider a market participant for that land. A person who is interested in, running a hospital in that land, maybe you can consider he also has market participants. And also, anyone who is developing an apartment in this land, piece of land, can be considered as market participants. So, different people are participating in the marketing market. So thereby they may have different intention. Thereby their prices are not, not really equal. The guy who is having an idea to develop a hotel may give a highest offer for this piece of land because he thinks that that particular place is more suitable for a hotel. Thereby we are getting the best available, best price. So I think you have discussed these matters under the fair value accounting standards. I'm not going to discuss those. Value in use, fulfillment value for liabilities. Value in use, fulfillment value for liability. Fulfillment means settlement value. Value in use means the benefits that you are going to derive from the assets. So thereby, so you can use the value in use and the fulfillment value. Reflect entities' specific current expectation about the amount, timing, and uncertainty of future cash flows. It's not the market participants' approach. If there is a land, if this land is currently used for an apartment or factory, we get the value of that land from that perspective only. We don't consider alternative participants. We don't consider the price that would be received for this land. We are just focusing on the value in use. So thereby the particular asset is dedicated now for a specific purpose. And from that point of view, we are going to identify the future cash flows, uncertainty, and timing. That is the value in. That's the difference between fair value and the value in use and the fulfillment value. And the third one is current cost. Reflect the current amount that would be paid to acquire an equal assets to receive to take an equal liability. That means you may have a particular machine. We maybe 2 years use. What would be the cost to replace such a condition machine to your organization. You are replacing the existing one. So thereby maybe a liability, maybe a assets. That is current cost approach. Measurements. The factors to be considered when selecting a measurement basis are relevance and faithful representation, because the aim is to provide information that is useful to investors and lenders and other creditors. So measurements, factors, of course, factors will be, relevance and the faithful representation. So thereby you see that throughout these standards, faithful representation and the relevance is the centrality. Throughout the conceptual framework, relevance and faithful representation is the centrality, central theme, central principles, central principles. Okay. Then of course, this chart, of course, you case relevance. Relevance of information provided measurement basis is affected by, I think I discussed all these things, variability of cash flows, sensitivity of the market factors or the risks. For example, amortized cost cannot provide relevant information about derivatives. Variability of cash flows. Relevance is, affected by characteristic of the assets and liability. Characteristic of the assets and liability and the contribution to the future cash flow. Characteristic means the variability of cash flow. Sensitivity of the value of market factors or the other risks, whether the cash flows are much more riskier, uncertain, or less uncertain, less riskier. So amortized cost, when you say derivatives, it is influenced by many factors. So thereby very difficult for you to use the historical cost, amortized cost. Better to use the market, oriented fair value approach. Contribution to future cash flows, whether the cash flows are produced directly or indirectly in combination with other economic resources. The nature of the entity's business activities. Now, for example, if you look at in financial instruments, investing in financial instruments, so that depends on many factors, not directly. It depends on economic factors, economic stability, macro variables, taxation policies of the government, interest rate of the government. Those matters are really influenced when you think about the financial instrument, not like machine, not like plants, not like furniture and equipment, intangible. So thereby, if something is in the, if your particular financial, if your particular asset or the liability is really in the market, if market factors are more influencing, I think contribution to cash flow is very questionable. So thereby better always go for what you call current value measurements rather than going for historical cost basis to improve the relevance. Then the faithful representation. Now, for example, assets are used to combination. Historical cost can provide relevant information about margin achieved in a period. Whether a measurement basis can provide a faithful representation is affected by measurement inconsistency and measurements uncertainty. If financial statement contain measurement inconsistencies, accounting mismatch, those financial statements may not faithfully represent some aspects. Does not necessarily. That's why when you look at any standards, always they tend to provide only limited alternative of measurements. Classic example is inventory. You are familiar. It has only two aspects: either to go for historical cost or NRV, whichever is lower. That is the idea. When you go to property, plant, equipment, intangibles, you may have property, plant, equipment, cost or evaluation model, a cost or fair value model. The only two. So that means measurement inconsistencies are really, we are trying to reduce measurement inconsistencies in our accounting standards. Measurement uncertainty also there. Then cost constraint is a matter for all that. Presentation and disclosure. Statement of profit and loss. Statement of profit and loss is the primary source of information about the entity's financial performance of the reporting period. Profit and loss could be a section of a single statement of financial performance as a separate statement. Statement of financial performance include total for profit or loss. In principle, all income and expenses are classified, included in the statements of profit and loss. Profit and loss is basically measure the primary sources of information into its financial performance for reporting. So there you get only the expenses and income and expenses, right? Profit and loss. Then other comprehensive exceptional circumstances. So the logic of producing other comprehensive income. The exceptional circumstances, the board may decide to exclude from the statement of profit and loss income expenses arising from a change in current value of an asset or a liability, include those income and expenses in other comprehensive income. The board may make such a decision. When doing so, board means the accounting standard board, not the particular organizations. Board means the particular the conceptual framework developed board. The board may take such a decision. When doing so would result in the statement of profit and loss providing more relevant information or more faithful representation. That's the decision. You have to remember here the board is not the particular organization board of directors. Here the board means the conceptual framework responsible people. In principle, income and expenses included in other comprehensive income in one period are recycled to statement of profit and loss in a future period. When doing so results in the statement of profit and loss providing more relevant information or more faithful. Classic example is the revaluation surplus. You recognize in the other comprehensive income, but at the time of selling, that will be realized. Recycling. So that is the idea of recycling. Concept of capital and capital maintenance, we will discuss next. Financial, there are two types of concept. One is the capital, financial capital, other one is physical capital. Financial capital is the net assets. That is your financial capital, net assets. Net assets means assets minus liabilities. Total assets minus total liabilities is called equity. But physical capital is a productive capacity. That is really based on, inflation matters are coming into this physical capital. Productive capacity. You may have 100 rupees yesterday, but you were able to purchase certain amount of particular item, your purchasing power, productive capacity. But today is, say prices has gone up. So by using the same resources, that is 100 rupees, you are not in a purchase to certain amount, same amount of assets. So thereby your productive capacity is questionable. So capital maintenance, financial capital maintenance and the physical capital. There are two concepts with regard to the capital. One is the financial capital, other one is a physical capital. Financial capital is basically what we adopt under the current financial reporting. Total assets minus total liability. But physical capital means the productive capacity. We consider the purchasing power aspect, inflation situation. Capital maintenance is, now, for example, what do you mean by capital? So there are two definitions. One is the net assets. That is our normal total assets minus total life. Other one is productive capacity. If you look at the productive capacity or net assets approach, whatever, financial capital or physical capital, you need to maintain the capital. Otherwise, what happened? The objective of the capital is to purpose of to have the capital. Capital means resources, remember. Assets, total assets minus total liability. So when you have the capital, what is your expectation? Accumulation. In this capitalism society, when your meaning capital means you are expecting to accumulate. You are expecting to increase. You are expecting to get a return for the current capital. Right? So thereby, obvious, to get the return, what you earned yesterday, at least you have to maintain the existing capital. For example, suppose you have a mango tree. So you get the yield as mango. So if you want to get the yield, what you have to do? If you get the mango yield, what you have to do? You have to maintain the mango tree. If you don't maintain the mango tree, you won't get the yield. Thereby, you have to maintain, look after the roots of the tree. If roots are not strong, if you allow roots to die or destroy, I don't think that you will get the yield. Likewise, what you have to do is you have to maintain the capital in your organization. If you are not maintaining the capital, like in mango tree, you won't get the yield. That means from our financial accounting perspective and auditing perspective, going concern is not there. If you are not maintaining, you won't get the yield. So thereby, what happened is you have to maintain the capital to ensure the going concern. So thereby, capital maintenance is linked with the going concern. Profit is only earned if the financial amount of net asset at the end of the period exceeds the financial net assets at the beginning of the period. Monetary amount, net assets at the beginning of the period exceed the financial. So it's a very, very simple concept. Very simple concept. You see, suppose end net assets. Okay, net assets beginning, say you had 150. Okay, net assets at the end of the year, beginning you had 100. So what is your profit? If it is 100, profit is 50. Profit is 50. But I know that you will agree with me, you need to make an adjustment for that. What is the adjustment? You have to add back the distribution, dividend declared, and you have to minus if there is any capital introduced, share issue or whatever. Then only you get the profit. So small modification. So if you want to make a profit, what happens is you can't consume more than the profit you earn. If you take a distribution as dividend, more than the profit what you earn, you are not maintaining the capital. That's why in dividend policy, we pay less, a certain amount of percentage of the profit as dividend, not the 100% profit. Why? Just to maintain the capital. So I think you got my point. So thereby, in our conceptual framework, what we do is in our organization, when we prepare and present financial statement, we adopt financial capital maintenance concept. In the sense, we believe that end of the net assets minus the closing net assets is the profit subject to adjustment, dividend distributed, and the capital introduced. Is it okay? Profit is only earned if the physical productive capacity of the entity at the end of the period exceeds the physical productive capacity at the beginning of the period. That's out of our control. We don't consider this. So thereby we don't maintain in physical capital maintenance aspect. in our reporting. Okay. Then I think that with that we have the limitations. The last slide. Yes, limitation of the conceptual framework or the particular format. First, it's very difficult to set up. Countries which are rich and developed can have their conceptual framework, but poor and developing nations can find extensive and time. So very difficult to set up this in Sri Lanka. Application of fair value models, value in use calculations, very difficult. Secondly, conceptual framework, while providing the standards of accounting practices, may lead to rigidity. It may be difficult to bring forward new ideas. So thereby, when you have a framework, always format is really destroying our innovation and creativity, new ideas. It's a kind of format. Always we have a definition, assets, liability, something like that. Substance over form. We have few concepts, so we don't deviate. Now that issue came really due to COVID situations. If you look at all the accounting firms, all these what do you call responsible professional accounting organization issued additional guidelines. Why? The conceptual framework does not really match with the new normal. So thereby they had to issue certain additional guidelines. So thereby it's rigid. It's for a normal setup, normal environment. But when the environment is changed, what happened is application of this particular framework is questionable, rigid. Third, conflict may arise between conceptual framework and the accounting standards followed prior to introduction of conceptual framework. When you use the prior accounting, the conceptual before accounting financial statements prior to conceptual frame, so thereby there are issues. Finally, conceptual frame may not be acceptably every partly, it may only benefit only some interested group identified as users. So you think that we are providing financial statement for the primary users, that is shareholders and the lenders. So thereby this is applicable for only that perspective. But general public, management decision making, some other researchers, you see, a politician's perspective, these are not really, conceptual framework is not really, they are not interested about the conceptual. So I think with that, so I have to complete my lecture. So if you have any questions, you can raise now. If you have question, you can raise now. Please. Seems that no question, then shall we have the two presentation? May I know the people who are responsible for the presentation? Yes. Otherwise, they will get the 0 marks because they have sent the video clips. I don't see any. Yeah. What again? Video clips.
Excuse me, sir. Can I know the groups that should present today? Because the last week was.
Right. Okay. I will tell you. No problem. Group number 5 and 6. So you can play the video. I will allow you to share because my lap is not take. I don't have the voice space. No problem. Yeah. Shall I share? Are there groups number 5 and 6? Another Kamurari. They can play their videos.
Hello, sir. May
Now,
I play the video? We are group number 5.
right, good. You can just play the video. Can you share? I think you can use the. All right, yes.
Differences in financial accounting, harmonization versus. Hi, we are group number 5 and this is our presentation about hypothesis link between society value, accounting values and accounting practice. In this presentation, we are going to talk about international differences in financial accounting, harmonization versus standardization,